welcome. The government has just delivered a stunningly low fiscal deficit number. The action now shifts to Mint Street, to the Reserve Bank and their monetary policy for the interest rate policy, which is due next Thursday. As always, the CNBC TV18 Citizens Monetary Policy meets to discuss the issues before the Reserve Bank and its committee. Joining me are Chairman Dr. Pronab and members of our Citizens Committee, Sonal Varma of Nomura, Sajjid Chinoy of JPMorgan, Samiran Chakraborty of Citibank, and Soumya Ghosh of State Bank of India. Gentlemen and Sonal, thank you very much for joining me. For a change, I'm going to start with the chairman. Well, because he's the Delhi guy. Dr. Sen, really, let's start with the budget. The fisc has delivered, and how? Deficit has been cut by 80 basis points compared to FY24 budget. Now, how does that change things for the MPC?
What the situation now is that the RBI doesn't have to live in eternal fear of the government going overboard with expenditures. So, I mean, that's a big plus as far as they are concerned. So they can actually start the process of normalizing, at least thinking about it as of now. And so, it really helps the RBI a lot. Moreover, the fact is that private investments still haven't started picking up the way we would really want them to. And so a little bit of support in that direction would I think help things along a lot.
Oh, okay. But Samiran, let me just tweak the government's position. The government has clearly delivered on fiscal deficit, but a big problem for the Reserve Bank is the lack of liquidity. So although there is durable liquidity, they have pumped in a lot of money by buying dollars. The immediate interbank liquidity was terrible. At the turn of the year, the deficit was as high as 3 lakh crore. So is the RBI still going to ask the government, you first spend your money? Will that be a big problem in terms of government action?
This is a more short-term issue, Latha. In our sense, if the government has to meet their deficit target for FY24, then over the next couple of months, the amount of spending that the government will have to do, that will more or less take care of this frictional banking system liquidity deficit issue by end of March. But there are a couple of things here. One is that the RBI needs to communicate with the markets that the reason for the weighted average call rate to stay closer to MSF rate is purely this liquidity issue and nothing to do with the stance of monetary policy, or it is not a stealth tightening that RBI is effecting. The other one is that, is there a possibility of relieving some of this liquidity stress even over this 2-month period? And we think that one of the interesting options that RBI could play with is to think of a incremental CRR cut, which is a very flexible tool, can be reviewed maybe even every fortnight. And that would probably mean that we are not using this as this VRR auctions as a painkiller to ensure that it does not go beyond 675, but we take some proactive steps to bring down the weighted average call rate back to the repo rate, which is the standard operating procedure of monetary policy.
Now, this is very interesting. The Reserve Bank put a bee in the bonnet when they did a ICRR, incremental CRR cut. Now, what Samiran is asking for the exact opposite, they had done an incremental CRR hike. Samiran is asking for an incremental CRR cut for a couple of weeks. That's a very interesting suggestion, and I hope RBI is watching this. Soumya, what's your take? Do you think liquidity will be a bigger problem than analyzing, inflation or growth at this juncture?
Yeah, thank you, Latha. I think liquidity in the current weeks actually is undergoing a structural phenomenon. I'll explain how. I think if you look into the contours of the liquidity, where the last liquidity has been in negative mode, the core liquidity, which includes the government cash balances, is consistently being surplus mode. The last week, I think couple of days back, the government surplus cash balances was as high as 5.7 trillion, which I think I have not witnessed in decades. So the clear issue is that the government is not spending and the RBI is trying to neutralize that through via liquidity injections. But a larger picture over here is that, whether it is going to be frictional, short-term or long-term in nature, my hunch is that the government is actually trying to move the spending pattern to conditionalities. So for example, the government is actually exploring the idea of a just-in-time mechanism process, whereby the money will be released into the system only if the earlier amount has been spent. So that means that these government cash balances will not be available with the banks, but with the RBI, only with the condition that if it is spent, then it will go directly into the states or the center. If that is the case, I think this will become a long-term issue. And for that, I think I'll just go beyond Samiran's suggestion a point, but I think what the central bank can build into the monetary policy, that it is already done. In a counter-cyclical element, for example, the LCF and the CRR could be adjusted when the liquidity is tight, and it could be adjusted also when the liquidity is easy. So basically, making it counter-cyclical and an automatic real-time policy stabilizer in times of stress or in times of surplus liquidity.
Oh, okay. Now, these are some seminal suggestions coming on how to tackle liquidity. For those of you who don't care much about this liquidity issue, the Reserve Bank looks at interest rate for inflation. That is the MPC's diktat. But they have a separate problem of liquidity where a large part of the bank's liquidity is with the government because they're not spending it fast enough. But there is no dearth of liquidity. So that's where the Reserve Bank is in a problem. They want to control inflation, but at the same time, they don't want to tighten liquidity so much that deposits go to 8%, which they are doing now. We'll come to that in a bit. Let me get to the longer standing questions. Sajjid, what is the Fed told us? It seems to be saying no cut now, but it looks imminent in May. So how will that impinge on the Reserve Bank?
But I think the broader point here is that the global environment, which was so threatening through all of 2023 and had become more benign towards the end of 23 as expectations of a soft landing took hold, I think that narrative has gained credence and support in 2024. If you look at where global growth was, despite all of the focus on a recession, even in the last quarter of last year, global growth was solid as a rock, 2.7%. First quarter of 24, running at 2.5%. So I think the expectations of a soft landing have picked up. And while everybody had focused so much on the demand side, the reason that growth is strong and we're seeing core inflation roll off around the world is because the supply side responded much more in 2023 than anyone had expected. This was not just manufacturing supply chains after COVID or food supply chains after the war. It was the fact that in labor markets, you had higher productivity growth and much higher labor force participation. So now the Fed finds itself in a bit of a sweet spot where growth in the US is holding up and core inflation is rolling off. Precisely because growth is holding off, many developed market central banks can take their time. They can afford to say that we're now getting confident of inflation, getting to our 2% target. But because activity is doing well, there's no need to rush this process. So I think that's the message that came through from the Fed, that there will be some easing in 24, but not quite yet. So we do think something happens in May or June, continuing the data. The same message has come through from the Bank of England. Now, what does this mean for emerging markets? There are two kinds of emerging markets. Some of them had raised rates very sharply, preempting the Fed in 2021 and 22 in Latin America. We're seeing sharp rate cuts from them, whether it's Chile, whether it's Colombia, whether it's Brazil. Other emerging markets like in Asia, which had not raised rates so aggressively, can afford to wait and are unlikely to front run the Fed. I think most emerging markets will unroll liquidity tightening measures, maybe pivot in terms of language, but are unlikely to cut interest rates till the Fed actually makes the first move.
Okay. So, well, that's a clear warning that the RBI also perhaps cannot move till the Fed clearly gives an indication. Sonal, ultimately the MPC has to look at inflation. We got two readings below the Reserve Bank's forecast and the market forecast. What's your sense? Should we expect the Reserve Bank to guide lower, bring down its forecast for current year and next year?
Latha, I think inflation focus should largely be retained. You're right. I think at least on the food side, we've actually seen a more broad-based decline in prices in January. And encouragingly, the food shocks we saw end of 2023 did not result in any second-round effect. So the drop in core inflation to below 4% is extremely encouraging. I think we're on track to get about a 5.4% for FY24. And FY25, the RBI's projection of 4.5% is largely on track. The two main risks to inflation going forward are the uncertainty on food prices and geopolitical related disruptions. But the drop in core, we think, it does imply that beyond the next 3-4 months, where high food inflation will keep headline inflation around 5%, we should see headline inflation converging to core around 4% beyond June. So we do see bulk of FY25 seeing core inflation below 4% and headline actually converging to core. So there isn't any need to change inflation forecast. There are risks, but I think things are looking much better.
Okay, that looks very satisfying if inflation is going towards core, but I need to take a break. And thereafter, the more important questions on how you guys will expect the MPC to vote on both stance and on its rate action. Back in a jiffy. Welcome back to the deliberations of CNBC TV18 Citizens Monetary Policy. I've been speaking with Chairman of our committee, Dr. Sen, and members Samiran, Sajjid, Soumya, and Sonal. Gentlemen, and Sonal, thank you very much for your patience. Dr. Sen, actually growth has been very good. The NSO has upped this year's estimate to 7.3, and next year's growth is also 7%, according to the CEA and the Reserve Bank governor. So why does the economy need any rate cut by way of stimulus?
Growth is good for a particular segment. I mean, the corporate India has done extremely well in the last 2-3 years. The point is the non-corporate sector isn't in that great shape yet, and they are the most interest rate sensitive. So the thing is that if you want to maintain a growth rate of around 7% into the long term, we'd have to get the corporate and the non-corporate sector back into some kind of a balance. At the moment, it is seriously imbalanced. So the focus is going to have to shift. The second thing, Latha, is that if you look at the data that we have from the corporate sector, corporate performance has started to slip a little bit. So one cannot take that growth for granted as of now.
Yeah, of course, those headwinds could be there. But Sajjid, your estimate of growth, are you as confident as what everyone is saying? 7.3, 7%, is growth safe?
Well, I think one has to be cognizant that in 2024, even though the world will be, in some kind of soft landing, that doesn't mean that we won't have headwinds. The global economy is slowing. We can see that both in, goods exports and service exports. So that will be headwinds. In 2023, India benefited from this large terms of trade shock as commodity prices came down. If to the extent that commodities stabilize or even move up a little bit, those tailwinds go away. And fiscal policy has been supportive last year. The broader consolidated deficit was flat last year, and there'll be meaningful and necessary consolidation next year. So there will be headwinds from growth. I think from an inflation perspective, Latha, very quickly, I think the reason the RBI can take some comfort on core inflation going forward is if you look at the drivers of core, really it's goods inflation that picked up last year because input costs around the world went up and firms had to pass it on. The minute commodity prices stabilized, goods inflation has come down. In India's case, services inflation just hasn't responded. Right? We've seen low services inflation for the last few years. And that would suggest to the central bank that there is still some slack in the economy. Labor markets are not too tight. On a broad-based wages are not picking up and pushing up service costs. So India's inflation story is very different from what we are seeing in advanced economies in terms of tight labor markets, high wages, high services inflation, and therefore gives the RBI later this year, when they've got more confidence about inflation trajectory, a little bit more elbow room.
Oh, okay. So you're arguing that inflation is not that big a threat. But you know, Samiran, what could happen, going by the way the numbers are, that core comes down. It's already at 3.8, it may go even below 3. And around 2, it is actually deflationary. It has a bad impact on the economy. But food may not oblige. It may continue to be high, and so the headline of 4 may be elusive. What does the Reserve Bank do at that time?
See, Latha, this is a very clear problem for any central bank, that it can't influence food prices. It can only influence core in that sense. And while we also have a tendency of putting all the blame on vegetable prices, but if you look at the non-veggie food inflation, that over the last 4 years have averaged more than 6%. And that's something which is creating this continuous pressure on the headline inflation. But having said that, why this is important to track the headline is that if you look at the cumulative headline inflation over the last 4 years, that's already almost 30%. Now, that kind of tells you that why in the lower segment of the population, there is this pressure on consumption, because the income growth might not have matched with that 30% overall inflation. So in other words, we could keep the headline inflation lower for longer to ensure that the purchasing power comes back with the lower segment and you have a more sustainable consumption growth.
Oh, so that means they have to persist with that pressure on interest rates. Soumya, the one thing that the external members will be upset about is that the repo rate has not been at 6.5. So do you think that will be a pressure now, and the Reserve Bank will have to move in the current policy in some fashion, maybe with liquidity, to bring it down towards 6.5?
No, I think, Latha, as of now, as I said at the beginning, that liquidity is going to be a little bit of worry for the central bank next year also, because next year you have those bond inflows peaking. So that's why I'm saying that why not build up a counter-cyclical buffer into the system, which can adjust it when the monetary policy cannot be adjusted. But having said that, I think just to harp on those inflation trends, I think even the fact that the core inflation has trended down to below 4%, but I think there is a limit to which core can increase, and we are of the view that the decline in core possibly could have bottomed out. So in that sense, I think even though there is an element of headline and core converging in the Indian context, but my sense is that that is not likely to happen at this rate. So at somewhere maybe around 5% or so, they could convert. So from that point of view, I think there will be still pressure on the central bank not to adjust the rates of the liquidity as of now.
Okay.
If they have got the things under control, why not wait for one or two policies to see how durable is the decline, and then take a call on rate adjustment in the future.
Okay, so that's the feeling I'm getting both from you and Samiran. But Sonal, if you can wrap it all up, would you say that we are moving closer to a rate cut at all, since inflation has started obliging? What's your summary, say, advice or expectation from the MPC?
Yeah, Latha, I think one step at a time. Growth has surprised positively. I don't think, we're talking about rate cut imminently. At the same time, the withdrawal of accommodation stance, which is a signal that the next move is a hike, is not necessary because we have seen actually core disinflation play out, and some of the risks have not materialized. I think given that backdrop, we need to follow, I would say, like a sequence, two-step procedure. First is tackling liquidity. Yes, it is frictional, but it's been tight now for since September. So it's a fairly prolonged period of stealth tightening, and it's come in the backdrop of macroprudential tightening that the RBI has done, which will have some, moderating impact on consumer credit going forward. So I do think liquidity is extremely important to tackle at this stage, and the tools that the RBI decides. I think, for instance, more longer-term VRR, FX swap are options that are on the table and should be utilized to ensure that the call rate gets back, within the corridor rather than staying above MSF or at MSF. That's a step I think should be addressed in this particular policy meeting. Step 2 is basically the policy guidance. We don't need to be signaling a hike. We don't need to be signaling a cut right now. But the stance has to essentially remove that tightening bias and move to neutral. So these are two things I think are quite important at this current juncture.
Okay, this looks like a divided house. So now as we get to the vote, I think it's going to be very interesting. First, the action, and there perhaps there'll be more agreement. Let me start with the first question. What will be the rate action from the MPC on Thursday? Samiran?
We are not expecting any policy rate action.
No action. Pause. Sonal?
Pause.
Okay. Soumya?
No action.
Okay. Sajjid?
Pause.
Okay. Dr. Sen, what do you vote?
Hold.
Hold. Okay. Pause. So the chairman is with the committee. That's unanimous. But I think on the stance we may have... let me rephrase the stance. Should the stance remain the same, prepare the markets for a change, or actually change? So, Sonal?
Prepare for change.
Prepare for change. Samiran?
Our base case is for no change in stance, but we would not be surprised if RBI does change the wording a little bit.
Okay. Okay. Soumya?
No change in stance as of now.
No change. Okay. Sajjid?
I would think, given inflation, soften the language to prepare for some change.
Prepare for change. Oh, good. We are getting some disagreement here. Dr. Sen?
They should prepare for a change, but at the moment, I think, given that nothing else is happening, I think it's better that they move to neutral so that the investors are given the feeling that better days are ahead.
Okay, so that's 3 different votes. 2 people no change, 2 people prepare for a change, and the chairman go ahead and change your stance. A final quick question. When do you all expect the first rate cut? Sonal?
August, with risk of earlier cuts.
Samiran?
We are also in August.
August. Okay. Soumya?
Second quarter, mostly August.
Okay. Sajjid?
If the Fed cuts in May, June is on the table, I think.
Okay, June and 3 August. Dr. Sen?
Not before June.
Okay, well, that's more or less. It's either June or August, and the committee is divided. I think it's for August that they are voting. Thank you very much, members of the committee. It is a little divided in terms of stance, but I think the big takeaway for me from the committee is liquidity is the bigger problem. And there we have 2 unusual suggestions. Samiran saying an incremental CRR cut, and Soumya saying a permanent counter-cyclical buffer to adjust liquidity. Thank you very much for this MPC deliberations.